Welcome back to your favorite channel, Make Money Online. Today we'll be looking at the state of the Nio stock and its projections. Watch this video to the end to learn about the up-to-date analysis of Nio stock's crash prediction. Nio, popularly dubbed the Chinese Tesla, stood out in an increasingly populated field of electric car stocks this year. It openly challenged Tesla in China as its electric car sales soared. It produces independent driving electric automobiles incorporated with upcoming generation technologies and AI. It also aims to offer automobile charging solutions that comprise Power Swap, Power Express, Power Home, and Power Mobile services. The company plans to expand its lineup with a couple of electric sedans starting in 2021. Backers of Nio include Chinese tech giants Tencent and Baidu. Nio stock belongs to the Auto Manufacturers Industry Group. Tesla is the brightest of this bunch, and its success is credited to be responsible for the group's rise this year. Nio itself ranks second behind Tesla and ahead of Ferrari within this group. In reality, on key earnings and other fundamental metrics, Nio still lags. It's still pretty much a young and fast-growing company, still looking to turn a profit. One of its major problems is financial. Nio, the pride of China's EV industry, was strapped for cash and close to being bankrupt in 2019. After seeing sales crumble and then dealing with the coronavirus factory shutdowns. Things took a dramatic turn. Nio stock was heavily bought by institutional investors when it launched. Its initial public offering stock traded well with decent institutional backing. Nearly a quarter of Nio shares are owned by mutual funds. 524 funds own the EV stock as of September, up from 347 in June. Threats to Nio stock. Due to the legislation unanimously signed into being in the House of Representatives, the situation looks dire for all Chinese companies whose shares are currently listed on various U.S. stock exchanges, such as NASDAQ or NYSE. The law specifically mandates the additional disclosure of intent from Chinese companies. This was aimed at ensuring that those companies are complying with U.S. accounting rules and overseeing their operations. It affects Chinese companies in the sense that the bill affects any company that operates using a public accounting firm that is located outside the U.S. and is unavailable for inspection or investigation by the U.S. Public Company Accounting Oversight Board. In that case, the Chinese company will have to demonstrate that it is not owned or controlled by a government entity within China. If the PCAOB isn't able to inspect audit reports for 3 consecutive years, then the law would ban certain companies identified by the U.S. Securities and Exchange Commission from having securities listed on U.S. exchanges. All trading activities under the SEC will be banned. The Chinese company's main problem lies in the fact that they have a law that directly counters the U.S. legislation. The companies are not allowed to share sensitive documents about auditing reports to anybody functioning as financial regulators. Therefore, it's easy to see how that would be a problem for Nio. This could hurt its chances on a global scale. Having shares delisted from the New York Stock Exchange would be a serious blow for any company, including Nio shareholders. This will lead most investors based in the US to enter a selling frenzy before the company gets delisted. This also means that they will experience great difficulty when selling or buying more Nio stock if they hold on to their stocks following the delisting. The implementation of the bill will surely take a while, and until then Nio is still pretty much an active participant in the New York Stock Exchange. Even once regulators have those rules on the books and can establish non-compliance, a range of appeals and other recourse would likely be available to Nio to delay any further action. This remains the biggest threat yet to the progress of Nio. Nio stock technical analysis. Shares of the China-based electric car startup are near record highs, but it hasn't been a smooth ride. Nio went public at $6 in September 2018, then hit a low of $1.19 in late 2019 due to sales and cash woes. Through most of 2020, Nio's share prices went sky high as the Chinese EV market rebounded. Nio more than doubled electric SUV deliveries for the first 11 months of this year. Nio and other Chinese electric car stocks have somewhat retreated in December, as the US considers requiring Chinese companies listed on the US exchanges to undergo annual audits or face delisting. Nio stock has extended from a late August breakout past $15.55. Shares also increased as Wall Street cheered sales momentum, thereby improving losses, margins, and liquidity. Plans for expansion outside China also lifted Nio shares. Since peaking at $57.2 on November 24th, Nio stock has pulled back in a volatile fashion, trying to find support at the 21-day exponential moving average. Nio stock earns an EPS rating of 56 out of 99. and an SMR rating of D on a scale of A+ to a worst E. The EPS rating reflects the company's earnings growth versus other stocks, while the SMR rating measures sales growth, profit margins, and return on equity. Nio lost 12 cents per share as revenue more than doubled to $666.6 million. Vehicle margin expanded to 14.5% from negative 6.8% in 2019 and 9.7% in the second quarter. Available cash more than doubled from quarter 2 to $3.3 billion in the third quarter. While earnings remain elusive, losses are narrowing. From a fundamental perspective, Nio stock is improving after debt and liquidity fears slammed shares last year. The outlook for Nio car sales and overall electric car sales in China seems robust, while an expansion in Europe is being closely watched. Major Wall Street firms also laud the EV startup improving financials and subscription battery business model. Similar to Tesla, Nio may become an EV battery player as much as electric car stock. Technically, however, Nio stock has run up massively and shares are not currently in a buy zone. Investors should consider waiting for the EV stock to pull back to the 50-day line or form a base before starting a position or adding to an existing one. Nio stock has seen some selling pressure over the last week. While the stock is still up 236% for the year, it's fallen almost 18% from its 52-week high of $16.44, which it hit on July 13th. Shares plummeted as much as 18% to $10.68 and could keep falling if Goldman's analysis proves right. Goldman set a $7 price target for Nio, implying a downside potential of 46% from Thursday's close. The shares are overestimated. Nio stock is high, more than 322% from an age previous, costly by outdated estimation metrics. That is why forecasters provided the corporation an auction rating, though they have a certain best aspect to voice the corporation. The organization is not cost-effective. Things seem to be turning around for Nio stock, but you can't ignore the truth that the corporation is still not cost-effective, at least not for now. It will take some time for the organization to get there. The momentum may not last. In 2019, it seemed as if the company would be reduced to scraps. It's improved considerably from back then, but it remains to be seen whether the company can sustain this momentum over the long term. Nio has yet to prove it can sustain true development long term. Nio stock may be a good investment, but it's still a risky one. The shares are overvalued. Nio stock has been up by more than 322% from its value last year, which is expensive by traditional valuation metrics. Although there are some good things to say about the company, it pays to be more cautious when it comes to Nio stock. The company's improved valuation may be too optimistic. The company isn't profitable. Things seem to be turning around for Nio, but it would be wrong to overlook the fact that the company still isn't profitable. And though profitability does seem to be in its future, it will likely take a while for the company to get there. Nio Stock Predictions. This chart shows the reported trend of Nio stock spanning hourly reports of the stock movement from November 11th to December 20th. The hourly chart is quite bearish, as the resistance around the 21 EMA negated the price, thereby preventing the price from triggering a rise at the pivot point at the green line. The price didn't increase, neither did it fall further below the support line indicated by the red line. This was a dangerous position for the stock. The price is effectively stuck between maintaining the red line and the resistance at the 21 EMA. It is a state of potential equilibrium, and it is unsure which direction the price will proceed, upwards or downwards. On December 4th, Nio completed a 20% weekly tumble amid Chinese shares fears and rival upgrades. New York Stock Exchange Nio fell another 5.48% on Thursday as the red week continues for the Chinese automaker. Chinese electric vehicle rival XPeng gets analyst praise and upgraded price targets. Uncertainty surrounding the future of Chinese stocks has also scared some investors off of the stock. Nio extended its fall on Friday, shedding another 4%. On December 5th, New York Stock Exchange Nio plunged a further 5.09% to close the trading week. It was one of the worst weeks of the year for Nio, as the stock continued to tumble during the last trading session of the week as shares fell 5.09% to close the week at $43.04. The stock crashed more than 20% in that week, and although these corrections are relatively normal, it was an unprecedented turn of events for a company that has risen by over 1,900% year over year. The immediate trigger for Nio's fall comes from taking a look at rival companies, such as XPeng and Li Auto. The EV market is unstable, and in the long run, Nio will tend to crash as much as it rises. Investors rapidly shift ground from one company's EV stock to another. That is, when a rival company's trend gets bullish, investors will stream to it. This had a direct impact on Nio Stock when other rival companies such as XPeng upgraded their price target. There is no clear-cut reason to panic over the potential of a crash for Nio Stock. If it crashes, it is bound to rise at some point to a new high. As long as it survives the delisting saga and competitive onslaught from other Chinese EV company stock, there is hope through the rough ride. We hope you enjoyed this video. Please don't forget to give it a thumbs up, subscribe, and click on the notification bell. What major stock news would you like us to talk about in this channel? Let us know in the comment section below. See you next time.